Welcome. Today we're diving into three foundational accounting principles: consistency, conservatism, and full disclosure. These concepts are essential for anyone looking to understand how financial information is prepared and presented. Whether you're a student, a business owner, or just curious about accounting, grasping these principles will help you interpret financial statements with greater confidence. Throughout this video, we'll break down each principle, explore their real-world applications, and see why they matter so much in the world of finance. Let's start by setting the stage for why these principles exist and how they contribute to trustworthy financial reporting. Accounting principles are the backbone of reliable financial reporting. Without a set of rules, companies could present their financials in any way they choose, making it difficult to compare results or trust the numbers. These principles ensure that financial statements are prepared in a consistent, fair, and transparent manner. They help users like investors, creditors, and regulators make informed decisions. In this scene, we'll look at how these principles create a level playing field and foster trust in the financial information companies share with the public. Start with the consistency principle. This principle requires that once a company adopts an accounting method, it should continue using that method from one period to the next. The goal is to make financial statements comparable over time. For example, if a business uses the straight-line method for depreciating assets, it shouldn't switch to a different method without a valid reason. Consistency helps users spot trends and make meaningful comparisons. If changes are necessary, companies must disclose them and explain the impact. This principle is all about reliability and comparability. Imagine a company that switches its inventory valuation method every year. One year it uses FIFO, the next year LIFO, and then back again. This would make it nearly impossible for investors to understand the company's performance over time. By sticking to one method, the company ensures that its financial results are comparable year after year. If a change is made, it must be clearly explained in the notes to the financial statement. This transparency is crucial for maintaining the trust of stakeholders. While consistency is important, there are times when a change in accounting method is justified. For example, a company might adopt a new method because it provides more relevant or reliable information. When this happens, the company must fully disclose the change, the reasons behind it, and the impact on the financial statements. This ensures that users are aware of the change and can adjust their analysis accordingly. The key is that changes should not be made lightly and must always be justified. Consistency principle offers several benefits. It allows stakeholders to track a company's performance over time, making it easier to spot trends and make informed decisions. Consistency also reduces confusion and the risk of manipulation, since companies can't change methods to present a more favorable picture. Ultimately, this principle supports the credibility of financial statements and helps build long-term trust between companies and their stakeholders. Next, let's explore the conservatism principle. This principle guides accountants to exercise caution when faced with uncertainty. In other words, when there's a choice between two possible outcomes, accountants should choose the one that is least likely to overstate assets or income. The goal is to avoid painting an overly optimistic picture of a company's financial health. This approach helps protect users from being misled by inflated numbers. See how conservatism works in real life. Suppose a company is unsure whether a customer will pay an outstanding invoice. Instead of assuming the best, the accountant records an allowance for doubtful accounts, reducing reported income. Similarly, if there's a potential loss from a lawsuit, the company should recognize the loss as soon as it's probable, but gains are only recorded when they're certain. This approach ensures that financial statements are not overly optimistic. Conservatism principle is designed to protect users of financial statements from surprises. By recognizing potential losses early and only recording gains when they are certain, companies provide a more cautious and realistic view of their financial position. This helps investors and creditors make more informed decisions and reduces the risk of being misled by overly positive financial reports. Common examples of conservatism in accounting include writing down inventory when its market value drops below cost, or recognizing an expected loss on a contract as soon as it becomes likely. These practices ensure that financial statements don't overstate the company's assets or profits. By being cautious, companies help maintain the trust of investors and other stakeholders. While conservatism is important, it shouldn't be taken to extremes. Overly conservative accounting can understate a company's true financial position and mislead users in the opposite direction. The key is to apply the principle reasonably and only when there is genuine uncertainty. Accountants must balance caution with accuracy to ensure that financial statements are both reliable and fair. Conservatism principle helps protect users from unexpected losses and provides a more realistic view of a company's financial health. By erring on the side of caution, companies can avoid overstating their performance and maintain credibility with investors, creditors, and regulators. This principle is especially important during uncertain times or when facing significant risks. Now let's turn to the full disclosure principle. This principle requires companies to provide all information that could influence the decisions of users of financial statements. It's not enough to just present the numbers. Companies must also explain significant accounting policies, uncertainties, and any other relevant details. Full disclosure ensures that users have a complete picture of the company's financial situation. Full disclosure covers a wide range of information. Companies must disclose significant accounting policies, pending lawsuits, related party transactions, and any events that could affect future results. This information is usually provided in the notes to the financial statements. The goal is to ensure that users are not left in the dark about any important issues that could impact their decision. Full disclosure is critical for transparency and accountability. By providing all relevant information, companies help users understand the context behind the numbers. This reduces the risk of misunderstandings and helps build trust with investors, creditors, and regulators. Incomplete or misleading disclosures can damage a company's reputation and lead to legal consequences. Let's look at some examples. If a company is facing a major lawsuit, it must disclose the nature of the lawsuit and the potential financial impact. If there's a significant change in accounting policy, that too must be explained. Even events that occur after the balance sheet date, but before the financial statements are issued, should be disclosed if they could affect users' decisions. These examples show how full disclosure keeps users informed. Most disclosures are made in the notes to the financial statements. These notes provide detailed explanations of the numbers and highlight any significant issues or uncertainties. For example, they might explain how inventory is valued, describe pending litigation, or outline related party transactions. The notes are an essential part of the financial statements and should always be read carefully. Failing to provide full disclosure can have serious consequences. Companies that withhold important information risk losing the trust of investors and facing legal penalties. Incomplete disclosures can also lead to poor decision-making by users of financial statements. That's why regulators and auditors pay close attention to the quality and completeness of disclosures. Full disclosure benefits everyone involved. It helps users make better decisions, protects companies from legal trouble, and enhances the credibility of financial statements. By being open and transparent, companies can build stronger relationships with their stakeholders and foster a culture of accountability. Now that we've covered consistency, conservatism, and full disclosure individually, let's compare them. Each principle serves a unique purpose, but together they create a framework for reliable and transparent financial reporting. Consistency ensures comparability, conservatism promotes caution, and full disclosure guarantees transparency. Understanding how these principles interact is key to interpreting financial statements accurately. In practice, companies must balance these principles. For example, they might apply consistency in their accounting methods, use conservatism when estimating losses, and provide full disclosure about significant risks. This balanced approach helps ensure that financial statements are both accurate and informative. It also helps companies meet the expectations of regulators and stakeholders. Sometimes, consistency and conservatism can seem at odds. For instance, a company may consistently use a certain method, but conservatism might require a change if the method overstates assets. In such cases, the company must carefully document the change and explain the reasons behind it. The goal is always to provide the most accurate and reliable information possible. Full disclosure supports the consistency principle by ensuring that any changes in accounting methods are clearly explained. This allows users to understand the impact of the change and adjust their analysis accordingly. Without full disclosure, consistency loses its value, as users would be unaware of important changes. Similarly, full disclosure works hand in hand with conservatism. When a company recognizes a potential loss, it must disclose the nature and amount of the loss in the notes to the financial statements. This transparency helps users understand the risks the company faces and make better decisions. These principles are not just for accountants, they benefit all stakeholders. Investors rely on consistent, conservative, and fully disclosed information to make investment decisions. Creditors use this information to assess creditworthiness. Regulators depend on it to ensure fair markets. By following these principles, companies serve the needs of a wide range of users. Auditors pay close attention to these principles when reviewing a company's financial statements. They check for consistency in accounting methods, look for signs of conservatism in estimates, and ensure that all necessary disclosures have been made. This helps maintain the integrity of the financial reporting process and protects the interests of users. Regulators such as the SEC and accounting standard setters require companies to follow these principles. They issue guidelines and rules to ensure that financial statements are prepared in a consistent, conservative, and fully disclosed manner. Compliance with these requirements is essential for companies that want to access capital markets and maintain their reputation. These principles are recognized around the world, though the details may vary by country. International accounting standards such as IFRS emphasize the importance of consistency, conservatism, and full disclosure. Understanding these principles is essential for anyone working with global companies or analyzing international financial statements. Ethical behavior in accounting is closely tied to these principles. Consistency, conservatism, and full disclosure all promote honesty and integrity in financial reporting. Accountants have a responsibility to apply these principles faithfully and avoid actions that could mislead users or distort the true financial picture. Applying these principles isn't always straightforward. Accountants often face complex situations that require judgment and interpretation. For example, deciding when to recognize a loss or how much detail to disclose can be challenging. The key is to apply the principles thoughtfully and always act in the best interests of users. Technology is changing the way financial information is prepared and shared. Automated systems can help ensure consistency and accuracy, but they also require careful oversight to maintain conservatism and full disclosure. Accountants must stay up to date with new tools and ensure that technology supports rather than undermines these key principles. Small businesses also benefit from applying these principles, even if they're not required by law. Consistency helps owners track performance, conservatism protects against unexpected losses, and full disclosure builds trust with lenders and partners. Adopting these principles can set a strong foundation for growth and success. Investors rely on these principles to make informed decisions. Consistency allows them to compare results over time, conservatism ensures that risks are not understated, and full disclosure provides the context they need. By following these principles, companies can attract and retain investment more easily. Creditors also depend on these principles. They use financial statements to assess a company's ability to repay loans. Consistency, conservatism, and full disclosure help creditors evaluate risk and make lending decisions with greater confidence. This reduces the likelihood of surprises and supports healthy business relationships. Management teams use these principles to guide internal decision-making. Consistency helps track progress, conservatism encourages prudent planning, and full disclosure ensures that all relevant information is considered. By applying these principles, managers can make better strategic choices and steer the company toward long-term success. Regulators rely on these principles to monitor the financial health of companies and protect the interests of the public. Consistency, conservatism, and full disclosure help regulators detect fraud, enforce compliance, and maintain confidence in the financial system. Companies that follow these principles are less likely to face regulatory issues. Employees also benefit from these principles. Transparent and reliable financial reporting helps employees understand the company's performance and job security. It also fosters a culture of honesty and accountability within the organization, which can boost morale and productivity. Society as a whole benefits when companies follow these principles. Reliable financial reporting supports economic stability, encourages investment, and helps prevent financial scandals. By promoting transparency and accountability, these principles contribute to the overall health of the economy. Good corporate governance relies on these principles. Boards of directors use consistent, conservative, and fully disclosed information to oversee management and protect shareholder interests. These principles help ensure that companies are run in a responsible and ethical manner. Financial analysts depend on these principles to evaluate companies and make recommendations. Consistency allows for trend analysis, conservatism provides a realistic view of risks, and full disclosure ensures that all relevant factors are considered. These principles are the foundation of sound financial analysis. Accounting students learn these principles early in their studies because they are fundamental to the profession. Mastering consistency, conservatism, and full disclosure prepares students for real-world challenges and helps them become ethical, effective accountants. As technology evolves, new challenges and opportunities arise in applying these principles. Automation and artificial intelligence can improve consistency and accuracy, but they also require careful oversight to ensure that conservatism and full disclosure are maintained. Accountants must adapt to these changes while upholding core principles. Looking ahead, these principles will remain vital as accounting standards evolve. New business models, technologies, and regulations will continue to shape financial reporting. By staying true to consistency, conservatism, and full disclosure, accountants can help ensure that financial information remains reliable and relevant. To sum up, the principles of consistency, conservatism, and full disclosure are essential for trustworthy financial reporting. They help ensure that financial statements are comparable, realistic, and transparent. By understanding and applying these principles, companies can build trust with stakeholders and support sound decision-making. Thank you for joining us on this journey through the key accounting principles of consistency, conservatism, and full disclosure. These concepts form the foundation of reliable financial reporting and are crucial for anyone involved in business or finance. By applying these principles, we can all contribute to a more transparent, trustworthy, and effective financial system. Stay curious and keep learning.